12 holdings in my ASX portfolio. And in this video, we're going to talk about 3 of them: Carsales.com, COLs and CSL. In this little video series, I talk about all the different holdings I have in my ASX share portfolio. Last video, I spoke about A2 Milk and ASX. And you can see the video from last week with a little bit of an overview about my different portfolios. Hi, I'm Michael and we talk about all things related to investing and personal finance. If you like the video, don't forget to click the like button and subscribe to my channel if you want to see future videos like that as well. And right at the beginning, also a quick disclaimer: I do not hold a financial services license, so I'm not a financial advisor. All the things you see here is my personal opinion and you should not consider this as financial advice. So let's get right into it, and starting with Carsales. So what is Carsales.com? It is one of the operators with the largest platform to sell cars here in Australia, so providing an online platform to sell new and used cars. They have also operation in other countries like Brazil, South Korea, Malaysia, Indonesia and Thailand. However, here in Australia, it's certainly the biggest market. And they're expanding into other markets to make sure that they continue to grow and to continue to grow their portfolio and exposure. Here in Australia, they run different platforms. The main one is carsales.com.au, but they have also web pages for motorcycle, boats and even caravans. And that makes up their main portfolio. Starting, as also in the last video, with looking into the charts. So when you see the 5-year charts here, you can see that there is certainly quite a good growth over the last 5 years in the price appreciation from Carsales.com. It started 5 years ago with around $10, and over the last years we had a very good consistent growth in the portfolio. There was a bit of a time in 2019 where it was a little bit uncertain, and in 2018-19 the company was not growing and they couldn't grow their revenue. It was actually declining just a little bit, but they were able to establish that up again. And as you can see, when we go into the 1-year chart, and even a little bit before that, you can see that the company was actually picking up. So the website was more utilized. Again, they were able to position themselves much better. And especially recently, they are doing very well. And the forecast for the next 2 financial years is actually positive as well. So there is some future growth to expect. However, when you see the price tag at the moment and the recent growth of the share price, it's certainly on a very high level at this moment, especially when you see from where the share price was coming just a couple of months ago. Looking into the financial situation, I mentioned already they were a little bit struggling a couple of years ago, but established themselves a little bit. So they have a return on equity that's actually relatively stable over the last year. That sits between 30 and 40% each year. The revenue growth, as I mentioned, was down 5% over the last 2 half-year results that were displayed, but there is a predicted growth again between 5 and 8% over the next, actually between 8 and 12% over the next 2 years. The current PE ratio is 48, so that's actually very high. I'd say for a company like that. Yes, there are not many competitors out there. However, I believe that the price tag is now quite high and that the share price got a little bit ahead of itself. Talking a little bit about the dividends, Carsales.com is a dividend-paying company, and the dividend payout was actually relatively stable. But because of their financial uncertainty over the last couple of months, the last time they actually had to pay out more dividends that they actually had earnings. So they had a payout ratio from 110%. It's usually sitting around 80%. So quite a sweet spot, sweet level for a dividend payout ratio. And the dividend percentage is 4%. So the 4% dividend payout. The forecast is a little bit lower though. So and the usual dividend was sitting around a little bit more than 3%, though 3.3%. I talked already a little bit about the reporting season. At the moment, it's hard for Carsales.com to do a lot of forecasting, so that's why the guidance for 2021 is not set out very clear. And because of the current situation, especially here in Melbourne and Victoria, they have created 100% or established 100% rebate for all car dealerships to make sure that they continue to stay customers. And obviously, because all that business is currently basically closed. Another thing that is not so positive for me is that the CEO has recently sold not a huge position of its shares, but 4.5% of its holdings into Carsales.com. So the CEO is actually selling some of its shares. It's not unusual, but it's obviously you would love to see that they obviously purchase more, which would be a strong indication for the future growth of that company. That sale was already a couple of weeks ago, so I think it was end of June. So since then the price has still appreciated, but still, and yeah, it's up until June there was also a strong growth in sales. So since the start of the pandemic until now, it was actually very, very positive for Carsales.com because more people wanted to buy a second car because people want to avoid public transport. So they definitely benefited from their recent situation. But the future is certainly a little bit uncertain. And yes, there might be need for the next couple of years because still people want to avoid public transport. But yeah, it's a bit of a question mark for me. And I personally have set up basically a trailing stop. So when the share price goes further up, I still participate, but if it falls down up onto a certain level, I will sell my position to actually take that profit and potentially find some new investments. So looking into the performance that I was able to achieve with Carsales.com, and there I certainly picked a very good timing to establish a position in Carsales.com, and that was in April 2020, so just a couple of months ago. And since then, the price has appreciated by over 70%, so 72% performance that I was able to gain on my investment in Carsales.com. So I'm really, really happy, and I had an average share price of my position of 11.7%. So very, very happy with that position and that growth of that company. Looking into the next company, and that is Coles. So what is Coles? Coles is one of the largest retailers here in Australia. There are two really large food and grocery retailers here in Australia, and that is Woolworths and Coles. Woolworths is a little bit bigger, larger. They have some more other brands under their brand name. But Coles is the second largest food retailer here. They also have liquor stores, and they provide groceries in their in fuel stations as well. So they work together with Shell, and they even have some financial services, a credit card, for example, and that's what their main business model is. So grocery and liquor are the largest ones, and the other ones are just to fulfill their portfolio. They have around 21 million customers, and they have 2,500 outlets here in Australia, which is quite a large number. Still a little bit lower than Woolworths, but very well positioned for their sales structure here in Australia. And there were part of Wesfarmers 2 years ago. So they had a demerger from Wesfarmers back then and were listed then on the ASX as an individual company. And that certainly has been positive for Coles, which we see in the share price. So back in end of 2018, they had that demerger. They got listed at a start for around 13 Australian dollars per share, and then you can see that it floated a little bit on a similar level for a bit, and then the share price appreciated quite a bit. And especially over the last recent months, because the grocery market was doing very well, the share price has also appreciated a lot. Even though the expenses and investments that Coles made were significant and very high. However, their sales growth was able to cope with that extra cost that they had. The return on equity is relatively stable, between 30 and 40% per year, and the revenue growth, obviously it's a very established business, so there is not huge revenue growth to be expected, but it sits between 2 and 6% each year. And the PE ratio, I would say it's a medium price to earnings ratio. It sits at 25 at this moment. And looking into the dividend, it's a very stable dividend paying company. The payout ratio sits at around 80% of their earnings. And that is usually around 4% of their share price. Looking into the current reporting season, I've talked already a little bit about the current situation. Still very healthy financial situation for Coles. One really interesting fact, and I think that's obviously one of the benefits for the future, the long-term future, that the online sales obviously have been increased enormous over the last couple of months because of the current situation. And so that was up 60% from last year, which is obviously a lot. And I believe that online sales will certainly increase even more now that people got used to the service. I have personally used it. I believe that the service is actually really good. You can either decide to get it delivered to your home, or you can order and organize a pickup at any Coles or at a lot of the Coles location here in Australia. And I find the service really seamlessly, very good online platform. Most products are available online, so I think that's really good. So it's a great shopping experience. Talking a little bit about the performance that I was able to achieve with Coles. It's a solid position in my portfolio. I bought into the company the first time back in end of 2018, really just after it got listed as an individual company on the ASX. Reduced my position at some point and added back into the position just recently when the share price was down a little in April 2020. And my overall performance with my current holding is just a little bit more than 16%. And along that way, I've earned also a couple of times dividend from Coles. So overall, we are probably even more than 23% on the entire holding. Now talking about CSL. CSL is a global biotech company, and it's actually the company with the largest market cap here in Australia. So it's all the way up on number one when you see the ASX 200 list, for example, and order it by market cap. So included in every ETF that covers the top market here in Australia. And it's one of the company that I'd say Australia is very proud of when you look at the companies and how they are doing and performing and developing over the last years. They develop and deliver innovative medical products. They also have plasma collection as part of their business, which is currently not doing so well. However, overall, it's pretty good and very, very stable, the company and the business. And especially at the current situation, they will have some future involvement in the production of a vaccine. That's at least very, very likely for the COVID-19 virus. And yeah, so a very solid, very good and strong company here in Australia. Looking into the chart, you can see that it's still set up for growth over the last years. The 5 years chart certainly indicates that there was a strong growth over the last years. When you see just the last year, it's a bit of an up and down, and we are not back at the very top height from the share price of the company at this moment. However, the company is still, as I said, set up for growth, so there's still some growth to come. And we'll see that when we look into the financials now. So very stable financial situation. The debt level is actually quite high. It sits at 75%. But it's managing this debt very, very well. The return on equity is between 30 and 40%, and the revenues is currently at around 13%. The forecast is a little bit lower, so the forecast and estimation are a little bit lower than what the company is able to achieve at this moment and was able to achieve in the past. The PE ratio sits at 42. It's for a pharmaceutical company, very average, but obviously for an established big company, relatively high. They pay out a small dividend. Payout ratio sits at around 45%, so they have still a lot of their earnings they reinvest into the company, and the 45% payout ratio equals 1% dividend that you achieve on your investment. The reporting season, I covered it already a little bit, was very strong, good financial health. The forecasting was in line, the reporting was in line with the forecasting, which is always great to see. That means that the management is doing a good job in presenting their financial data. And as I already mentioned, the debt level is basically consistent on 25% net debt to equity. My performance with CSL, I got into that stock the first time back in 2018. Reduced the position again and bought back into the company, and added back to my position in April this year. However, the greatest performance, the biggest part of that performance was actually back in 2019 and 2018. Currently, I have the share price is plus 11% when you compare it with my average purchase price, and my average purchase price was 253 Australian dollars per share. So yeah, those were the 3 stocks for today: Carsales.com, Coles, and CSL. So recapping again very quickly, Carsales.com had a great performance over the last couple of months, and obviously one of the greatest contributors to my overall performance in my portfolio. However, I believe that the share price got ahead of itself, and I might think about reducing that position. And as I mentioned, I have set a stop to gain this performance and to actually take profits. For Coles, I believe that's it will and the same for CSL. Both of those companies, slightly different setup, but obviously both are set up for long-term future growth, and I will hold on to those positions for certainly a little bit longer if the financial situation will not change for those companies. Next up, so in my next video, we'll talk about Fisher & Paykel and about Jumbo Interactive. Both really interesting companies, some totally different stories behind those companies, so look out for the next video. And yeah, I thank you for watching this video. It was a little bit longer because obviously we had 3 holdings to cover. Don't forget to click the like button, and I'm looking forward to see you in my next video. Until then, bye.